Welcome to the stage Paul Jackson, CEO at TUHF, to discuss purpose-built assets and the growing case for developing built-to-rent assets for institutional and impact investors in Africa. Hello. Please, a round of applause for Paul.
Thank you.
Lovely to have you, Paul. Joining Paul for this discussion, we have Carel, Kleynhans, CEO at Divercity Urban Property Fund, Amelia, Dieperink, Affordable Housing Head at Absa, Debra, Managing Director of Real Estate Project Finance at Development Finance Corporation, and Zanele, Mocumi, Portfolio Manager, Developmental Impact Investments at Eskom Pension Fund. Please help me welcome the panel to the stage.
Well, I hope I'm not by myself here.
I mean, you and I can just start a conversation whilst we wait for everyone, Paul. But you are welcome to start telling us what you're going to be talking about. Give us a little bit of an intro. Thank you.
Thanks a lot, and hello, everybody. I was going to set the scene after the panelists had introduced themselves, but seeing as I'm doing an alone show up here, let me set the scene. So today we're going to be talking about low to moderate income rental housing. And we're talking both about multifamily housing as well as student housing. And primarily based in inner cities, in cities. In city, hello Zanele.
Hi, Paul.
Primarily based in cities, and usually a mixed use type development with sort of ground floor retail or some education in a primarily residential real estate play. The portfolios we're talking about are usually multiple buildings, but sizable portfolios of kind of 4,000 to 6,000 flats at a time, situated in usually geographically concentrated, but in multiple buildings. And we are talking about private sector rental, commercially run rental. So it's often good to say, well, that's what we're talking about. What are we not talking about? So we're not talking about social housing, subsidized housing, housing on the periphery of urban settlements, those kind of things. We're not talking about that. We really are talking about private sector commercial housing. And we hope to cover the commercial case for this and why this asset class continues to be underrepresented in capital market investments when compared with other asset classes. And we're also talking about the impact case. And just because I represent an impact investor, I just want to be very clear. Impact investment for the next 60 minutes is hard, risk-adjusted commercial returns and significant development impact. It's not one or the other. There's no concession in what we're talking about. Right, guys, the MC has introduced you guys, so can you just tell us a little bit more what's your role in your institution and for the banks and the pension funds, and then what does your institution do when we get to you, Carel? So can I start? Amelia has just been on an epic journey, so we're very happy to see her. Amelia, your role at Absa.
Thanks very much, Paul. So my name's Amelia Dieperink. I head up the commercial property finance affordable housing business at Absa. So effectively what we do is we fund developers and investors in the affordable housing space, whether that's for rental or for sale. From a strategic perspective, this is obviously very core for us. It's a long-term play. It's a growth area. So a space that we're very committed to. I think one of the things that potentially kind of distinguish us and make us so good at what we do is that we have a dedicated team who have many years of experience in this space, which just allows them to find solutions that are workable for our clients to help them get their developments off the ground. So yeah, it's a pleasure to be here today. Thanks, Paul.
Thanks, Amelia. Let's move to you, Carel. Hello, Debbie. It's not on.
Not on. There we go.
Now it is.
Cool. Yeah, thank you for having me. It's a pleasure to be here. So I head up Divercity and specifically the fund side of our business. So we kind of like to say that we spend all the money that Amelia is so kind to provide us with. We develop, own and manage affordable rental assets predominantly in Gauteng at the moment. We've got a portfolio of about just under 7,000 units at the moment, and we're looking to expand that nationally. You know, as I guess will come out in, you know, over the course of this conversation, I personally really believe in this asset class, and I think it has a fantastic, you know, place in the property investment landscape within any economy, specifically pertinently, I think, on the continent where we are right now. And yeah, it's a space that we see tremendous potential in, and it's something we're very passionate about kind of contributing to and growing as we grow our business as well.
Thanks, Carel. Debbie, welcome. A quick overview. Sorry? Go for it.
I'm Debbie.
Yes.
Nice to meet you.
Yes.
Hi, everyone. I'm Debbie Erb. I'm the managing director, which basically means I manage a team of officers at DFC, which is the United States DFI. And my team, I would say 90% of what we work on is real estate related, but we've done some hospitals, some university infrastructure, other schools, but the vast majority of our portfolio is in housing and affordable housing, with a little bit of sprinkling of retail and office buildings, and hopefully some logistics someday.
Thanks, Debbie. Zanele?
Thanks, Paul. Okay, it's on. Hi, good afternoon, everyone. My name is Zanele Mocumi. I'm a portfolio manager for impact investments at the Eskom Pension and Provident Fund. The portfolio I manage is, you could say it's largely property focused. When we do look at education and form of education, look at student accommodation as well as primary and high school, and we provided capital in the actual buildings of the schools. We also look at social housing as well as affordable housing. We've taken a large focus this year on agri as well as healthcare. Especially healthcare in the form of pharmaceuticals and primary healthcare as well. We've also taken a look at, we also invest in renewable energy as well as township retail. Thank you.
And then the company I represent is a commercial property financing company. It's a non-bank financial services company that specializes in low to moderate income mixed-use developments. And we are only in the big metros, so we're represented currently in 7 of South Africa's big metros, and considering to move a little bit more Africa-wide in due course. Right, so that's the panel, and thanks for being here. So let's start our discussion by asking the question, and the first question, if I can pose to Carel and Zanele. What are the key attributes of this? What makes the investment case for residential real estate? We'll come a bit later to why is it finding it hard to get the kind of traction that perhaps you think it deserves. Let's start with you, Carel, and then we'll move to you, Zanele. Go for it.
So maybe I'll try and answer the question by posing a somewhat provocative statement to the audience here, and that is that I think, you know, we all, as, you know, property practitioners on the continent, are missing a bit of a collective beat when it comes to affordable rental housing. Oh, sorry, not just affordable. I think I want to make this initial point just more generally about rental housing as an asset class. And the reason I say it is, if you look at, you know, many of the more developed kind of markets, especially capital markets around the world, the US, Europe, rental housing forms a large portion of the commercial investment property sector, right? In the US, about 20% of listed real estate is residential rental. And, you know, just to give you a sense of the potential size of this industry just locally in South Africa, there's about 7 trillion rands worth of, residential assets in South Africa. About 1 trillion of that is in the kind of affordable to mid-market rental space. So these are rental assets presently occupied by people renting in them. That's, you know, larger than the entire South African property retail property sector, and twice the size of the entire South African industrial and office sector combined. So the point is there's an incredible amount of assets in this space. They're just mostly owned through a couple of small mom and pop investors here and there, people who have a buy-to-let property that they're renting out on the side and the like. So not a lot of this is sitting within the institutionally owned and managed investment landscape. But if we can see this market maturing to a place where it looks a bit more like a developed market, as is the case in the US or in Europe, it could be an incredibly large portion of our collective kind of landscape for everyone from the architects to the bankers, asset managers, developers, and investors in the room. Everyone has a large kind of untapped opportunity here if this asset class matures, as we certainly believe it will. So maybe I'll kind of stop there, and I can add to what I think the attributes of the asset class are. But I think it's a huge opportunity.
Zanele, do you agree or?
Yes, I do agree. I think if you look at the sector, it provides a lot of political stability. Without decent accommodation that's very close to places of economic opportunity, every other sector you invest in doesn't necessarily make sense. Whether it's education or healthcare, or you have an investment on the JSE, without decent accommodation, close to work opportunities, you start having an unstable portfolio. I think what makes it very difficult to invest in this particular asset class is the fact that there's very little consolidation. So what we'd get as pension funds is, an entrepreneur here and there, looking for with a small building, a small transaction, trying to redevelop a small, zone in a street. And that's not the game of pension funds. The game of pension funds, we manage large assets. So in our case in particular, if a transaction is less than 100 million, it becomes very, very difficult to make sense for asset allocation. So this is the problem then with the sector, is that there's very little consolidation that actually makes sense to the institutional investor. And when the transaction comes in small sizes, you ask yourself, if I'm an equity investor in this, how do I exit? How do I actually formulate a plausible exit strategy? But Paul, what we are looking for in this asset class, like any other asset class, is stable cash flows that are predictable over a long period of time. We are also looking at capital appreciation at the same time, as well as plausible exit strategies. Thank you.
So Carel, coming back to you, you involved with a fairly sizable fund, and you've just been through the pandemic. What's the demand like? Are your buildings full? How have you performed post the pandemic? To Zanele's point of stable cash flows, I guess.
I'd like to answer that. I just want to add on to something Zanele said. I think this challenge of creating portfolios of residential rental assets that are large enough that institutional investors can actually invest in them is really core to this discussion as I see it. So we're fortunate that we've managed to accumulate a portfolio that is now of a size where we can start engaging with pension funds, and we get some of the benefits that come with this asset class that really are linked to scale, and those are this diversification of income streams. So we've got over 7,000 tenants living in our buildings. These people all are on different kind of lease life cycles. So as a result of that, we don't have all of our cash flow coming up for a renewal event at one big lease expiry date. Every single month there's a natural kind of churn, and with that also repricing to the market that happens as a result of it. So we're constantly repricing to the market every single month with a period of our portfolio. The result of that is that during periods of extreme economic distress, as we've just been through with the pandemic, our view, and again, it's not just our view, we've seen this in our own assets, but it's also something that is kind of commonly understood of this asset class in markets where it's more developed, is that the asset class holds up quite resiliently in the face of significant economic strain, partly because your income stream is so diversified. You've got all these different people that not everyone loses their job on the same day. And equally, you've got smaller portions of your portfolio that if it becomes distressed, you can re-tenant and re-let and reprice again to the market much more easily than you could if you've got, for example, an office portfolio with 4 tenants that each have 20,000 square meters of rental space with you. So to answer your question, we definitely saw a spike in vacancy at the start of the pandemic, especially in our more affordable units in our portfolio, people who were working in kind of more in the semi-informal sector, so Uber drivers, people working in restaurants, people working in retail jobs. A lot of these people, initially became financially distressed, and some of them had to move out. But we also saw very quick recovery as the economy started trading again, as the hard lockdown eased up. And if you look at our cash flow over the period of, let's say, the 24-month period of the pandemic, there was a blip at the start, but it recovered much more quickly than I think some of the guys with large office portfolios that are seeing significant vacancies now have experienced.
Thank you. The joy of a multi-sector economy of big cities. Debra, perhaps I can move to you and just say, from your perspective, this asset class and its sort of capital formation, its impact investing attributes, could you give us a comment on that?
Yeah, absolutely. After it's been almost 20 years trying to support construction of for-sale housing, I think it's become pretty clear to most of us that have been trying to do that we need to be thinking more carefully about rentals. We have increased mobility, especially with young people within emerging markets, and it's just not suitable to buy houses in that kind of an environment. In general, mortgage markets in Africa have not developed as quickly as any of us hoped, and the interest rates are still high, and the loans are not affordable. It's difficult to get credit, especially for lower income families. So rental housing is the right solution for that, I think. Obviously, from an impact standpoint, one of the things that we're interested in green, we are interested in housing that's suitable for young women and single mothers, for example. We want it to be climate resilient, we want it to be well located, transit located, all the buzzwords that you hear about residential projects these days, all of that's true. In for sale housing, it's very difficult for us to control the outcome of whatever we finance. So if we finance for sale housing at an affordable rate, at a low interest rate, there's no way for us to ensure that project stays affordable. Those houses could be flipped pretty quickly into a higher end product, especially when you've got very limited supply. The other thing is it's very difficult to track what happens to those families. Do we actually have the impact that we intended to have in terms of water and electricity usage and general health of the family, better education for kids? If you're in a multifamily environment, especially when you've got good property management, it's a perfect environment for tracking those things and having a relationship with your tenants where we can collect that kind of data. I would say also, although subject to further discussion, that the green elements I think are easier to incorporate into a multifamily project. The benefits are clearer from a property management perspective than they are from for sale housing. So we definitely want to focus on rental housing. The trick is the barriers, which I'm sure we'll talk about as well.
In a moment, yes. Amelia, would you like to add to that? Are you seeing significant impacts from your investments? What are your thoughts on it?
Yeah, Paul, so I think Debra's covered it beautifully. What I would just add is obviously in the current economic environment, inflation, increasing interest rates, we are seeing a decline in activity in your first-time home buyer segment. So really, when you could 6 months ago potentially afford a house for R1 million, you must probably be sitting at 800,000 at the moment. So I think in the current environment, there's a real push towards rental. I think rental is just going to become so much more impactful to facilitate families, managing their budgets, the flexibility around being able to move depending on your work opportunities, saving on travel costs. So there's a very strong case for rental in the current economic environment.
Yes, rental housing is counter-cyclical in many respects, and particularly in a rising interest rate environment. Carel, would you like to wrap up? I mean, we made the case that there's a commercial case and an impact case, and we're not giving up on either to achieve our, or is there something else you'd like to add?
Yeah, I think we can move on from the point. I think it's very important to stress this point that rental housing is not just an impact story. The impact fundamentals are absolutely there, to the point that Debbie was making, and we really believe in the impact thesis of our business and this asset class. Having said that, I want to reiterate this point again, that this is a large portion of most developed property sectors' globally, and it's very underrepresented in the South African market and almost non-existent on the continent. And there is, and we'll talk about the fundamentals a bit more now, I'm sure, but it really is a massive opportunity for institutional capital in particular to get into the large sizable investments of the nature that Zanele was referring to. Income streams that are fairly predictable. Maybe, Paul, if I may, I just want to quickly say something on that. I've remembered now I was thinking about it as Zanele was speaking. An underappreciated feature of large residential portfolios, and specifically insofar as their income earning potential is concerned, is that the income streams from these portfolios are incredibly forecastable. If you've got a large portfolio of, for example, commercial assets like an office building, you've obviously got leases in place, and that feels very good in the short term because you've got this contracted escalation cycle that will last 5 or 7 years or 10 years if you're lucky. But the challenge becomes around how you model what happens at that lease expiry date. So if it's 10 years in the future, you may have quite a substantial market reversionary event, either up or down in terms of the income. Often what happens is savvy developers manage to negotiate above inflationary escalations in the leases that they negotiate with the tenants. But the reality is that in the long run, things can't get more expensive in real terms, right? You can't keep beating inflation by 200 or 300 basis points a year sustainably into the future. So it has to revert to inflation at some point. And the thing with residential, and I mentioned this earlier, is that residential is constantly repricing to the market. So every month, from an asset management point of view in our business, we look at, what's vacant in our portfolio, we look at, what those units would price at in the market at that given point in time, and in that way we're constantly repricing to the market. So for an investor like Zanele or a pension fund that's trying to do 20-year asset liability matching into the future, you can with a much greater certainty say that this income stream is going to, in a fairly smooth, unvolatile manner, track inflation over that period. If it's well managed, and perhaps we can talk a bit about the big ifs that are required for that to be the case. But if it's well managed and it's diversified and it's at scale, then you've got this really nice income stream that there's a place for in, I think, the capital landscape.
And I think you raised the critical point about the importance of specialized and very high quality property management. We'll come back to that. So let's talk about a real live example. I believe you've got a couple of slides, have you?
Yeah, that's right.
So just to get a sense of what we're talking about. And then I'm going to ask Amelia, because Absa funded this, not this one, but particularly, yes. Well, you did that one too. Okay. But how she got it through credit. It's going to be about as simple as that. So Carel, we're going to be talking about Barlow Park. I see this is Jewel City, but doubtless you'll be just a quick slides in the market. Where is Barlow Park and what's the kind of product you're targeting there?
So I think the purpose of showing a couple of images is to...
It just went off.
So we just wanted to show you a couple of pictures of what we actually mean physically when we say large residential rental assets, right? Because there's quite a few ways in which you can build resi, and I think what we're specifically talking about here are essentially apartment buildings. So this is a precinct of ours that we've developed in downtown Joburg. It's called Jewel City. It's on the eastern part of the CBD, and as Amelia mentioned, Absa was the senior, actually development financier and senior lender on the project. It's just over 2,000 residential units, and it's as diversity, and I'm not saying everyone in the rental space has to do it this way, but we like to focus on precincts. So we really believe that when you develop kind of in excess of 2,000 units or so in a place, what it allows you to do is to also add that essential amenity offering that we believe is very important for a residential area to be successful. So in Jewel City, we've got a national retail grocer, we've got a pharmacy, we've got a clinic, doctors' rooms, nurses, physios and the like. We've got a primary school, a high school, a gym, sporting facilities, restaurants, and all the kind of things that you need to live a good life, really. And this is quite different from the predominant mode of affordable housing delivery in South Africa, where we have historically typically developed affordable housing at the urban periphery, far away from amenities. So the result of this is that people are commuting up and down to go to work, to go to where their kids go to school, and to buy their groceries and all the other things you need to do on a day-to-day basis. the benefit of doing it in this way is that, people can kind of, it's that cliche, but cliches are cliches for a reason. It's a real live, work, play kind of environment. And just to say, so I just want to share with you another project that we've just broken ground on. We're kind of busy piling this at the moment. This is called Barlow Park. For those of you familiar with Joburg, that's the location. It's basically right on the edge of Sandton, really kind of in the center of the greater Johannesburg. And it's a site of 4,400 new residential rental units with a retail component and a primary school and a high school. And this is just broken ground about 2 months ago, so we're on site now. And this is just a kind of a sense of what, just an artist's impression from what it'll look like from the one vantage point. And again, just to stress, we really believe that assets of this nature, so this is in the first phase, it's under construction now, it's about R1.5 billion asset. This thing will, generate, high quality, low volatility, forecastable income, for, if we do a good job the next century, really. There's no, these assets don't reach an expiry date where, the kind of, theme of the day or the flavor of the month around, what people like in office buildings has moved on. If you have well-located residential, and maybe, Paul, that's something we can talk about as well, but well-located residential kind of globally, historically, has always kind of had a place, right? At the end of the day, people need to live somewhere, and if it's in the right place, people will always want to live there. So that's what we're doing. I think just one more image of what it looks like.
Great. I think that sets the scene well. We're going to be asking Amelia how she persuaded, what were the kind of considerations that Absa took into account, and why is it that you're now financing this? What Carel didn't tell you was it's right next to Sandton, but it's also right next to a township called Alexandra, so it's like in the middle. Amelia, so how did you get it through credit? I mean, what did your paper look like? What are the kind of issues that you were grappling with in order to make the investment case?
Yeah. So, Paul, I'm actually just going to touch on the Joburg inner city for 1 second. So, from my perspective personally and from an Absa perspective, we have a passion for the Joburg inner city. I just feel it has so much to offer in terms of delivering housing at scale and quite rapidly. So, I really feel it's important that all the banks and all the players support the inner city because of what it has to offer. And then switching over to Barlow Park, I touched on earlier the key focus that affordable housing has at Absa. It's a growth area. It's core to what we want to do in terms of contributing to the housing needs of the country. So, when a deal like Barlow Park comes through the door, and it was an extremely competitive process across all the banks, but when you looked at the core fundamentals of this transaction, it was absolutely a deal we wanted to do. So if you think about the players involved, Divercity, Atterbury, Barlow World, Wilman, Twin City, all very well-established businesses with extensive track record in property management and development. So that box was absolutely ticked. If you think about the offering that Carel's just touched on now, we absolutely believe in that offering, the demand, and we know and trust in our client to deliver a quality product. So really all the fundamentals stacked up on this transaction. And to be honest, the affordable journey at Absa has been quite a long journey. We started from scratch in 2016. So we've gone through quite a process in terms of educating the bank internally around how to look at this asset class. Often there's a lot of perceived risks, short-term leases, tenants that are exposed to the, downturns in the economy, damage of property, bad debts, the list goes on. But the reality is they're very strong mitigants around that, and one of them is obviously around property management that's so key, and obviously delivering the right product at the right price, right location. So kind of those are all the aspects we looked at, and it kind of perfectly fits into our overall strategy that we're looking to do as a bank. And then lastly, obviously, credit metrics stack up. The bank obviously looks at its returns if it makes sense for us to put out that capital. So it was a very robust debate, but I'm super proud of having done this transaction, and I'm sure it'll be a huge success, and I look forward to whatever we can do next.
And beating the other banks to it, eh?
You said it.
Yes. Okay, one of the things that TUHF often runs into. Our book's about 4 billion rand. We've got about 25,000 flats on our books together with substantial retail as a financier. We run into the grand mandate problem. When we're talking to the capital markets and to asset managers, we are seeing, we're running into these perceived risks. We're running into portfolio managers who want to do the deal, but they don't have the mandate. Zanele, if I could start with you, what changes are happening, do you think, in the capital markets in terms of even Eskom pension fund and in terms of the regulations that might start easing up this quite difficult issue of portfolio managers with a mandate to in fact invest?
So there have been new changes that have been announced with Regulation 28, where pension funds can invest a lot more of their assets into infrastructure, and I guess affordable housing would fit into that as well. But I think the real problem, Paul, is not necessarily Regulation 28. It is the fact that South Africa as a country is going through a very deep, long cycle of a recession, and that we just seem not to be able to get out of. And what that means for a pension fund is that you're not getting, your cash outflows are starting to be far greater than your inflows. And that actually impacts liquidity. So our ability to be able to have patient capital that can withstand building cycles of 5 to 6 years, 7 years, is actually getting quite limited. So yes, you'll have, your heart is that you want, as a pension fund, to be able to play in the space, but you don't have actually the ability, the liquidity to actually to wait that long for building to actually to take place. So that's actually the real problem, that greenfield investments where pension funds have played a part, a bigger role. Even with Regulation 28, it's not going to solve that. We don't have a lot of young people coming into the pension fund system, staying for long years. What we actually have now is a lot of people, middle-aged people, withdrawing their pensions because they're highly indebted, and then we've got a lot of old people basically about to retire, and that actually changes our asset and liability matching. So that's actually a big problem. With the other problem, so what we've done, to support the space is that we've actually said, well, let's then support, for instance, accommodation, affordable housing, once the assets have already built up. But that leaves a significant gap in the market where who takes then the initial equity risk of when these assets need to be built up. And I think that's what South Africa needs to solve for, in terms of the DFIs need to play a role, and then perhaps then exit into the pension fund, who's actually looking for long-dated cash flows that are actually quite regular. The other component that we faced with is the regulation that I think is before Parliament. They're discussing the two-part system, where people can withdraw about a third of their pensions whilst they're in a job, and then the 2/3 will remain until retirement. I think in the short to medium term, that creates a lot of volatility from a pension fund asset liability matching as well, because all of a sudden you need to have a lot more liquid assets than what you had anticipated. We haven't tested, I haven't seen the economic model for a pension fund, but it does actually weaken the case, again, for greenfield investments, where a pension fund would naturally form part of. So that's where I think the regulations are going to be. But again, like I said before, the ability of the sector to consolidate. So whilst, capital is being given to build, there are other assets that are actually cash generative already, and can actually provide then the pension fund with stability. Without that, it becomes a very difficult investment case.
Thank you, Zanele. Debbie, maybe we can move to you, because this has been a very South African kind of focused discussion thus far. And can you, in your experience in the rest of our continent, are you running into similar problems? Are there unique things? I hear a lot of discussion in places like the African Union of Housing Finance, the importance of local currency bonds, those kind of things.
I would say that, I was thinking about this, in terms of this institutionally managed, affordable rental housing, it pretty much doesn't exist. I haven't seen, aside from what Acorn's working on doing in Kenya, outside of South Africa, I haven't seen it anywhere. Most affordable rentals are, it's informal, single owner, or very small apartment buildings that are managed by, the owner. So that's part of the problem. I think even though we say we want to do this, we can't find the types of companies that have this capacity to manage this particular type of property. So there might be property managers out there that are experienced in commercial or high-end residential, large-scale projects, but it is a very specific type of management style. The requirements are definitely different in the affordable space. And so a company that's been managing higher-end projects or diplomatic housing is probably not going to be immediately suitable for this. Whether there's an opportunity to create partnerships in order to bring that capacity to bear, either from the US or Europe or from South Africa, but I do think that that's something that we need to work on. Perhaps with some technical assistance funding, we can help create that capacity. On the funding side, I've heard similar things, from pension funds. We can provide local currency guarantees, and I would love to figure out ways to credit enhance these types of instruments in order to attract more pension fund investment in the space. But so far we haven't. The scale issue is definitely a concern, liquidity, and then price competition, which was mentioned earlier in the other panel. So we're definitely interested in looking at ways that we can help companies build portfolios of assets that then could be refinanced through a REIT structure or some other kind of bond or investment structure with local pension funds. And I think we can play a role there. But there definitely has been a challenge in, number one, it's capital intensive business. Number two, it requires long-term investment, upfront equity investment, and that's not been easy to find investors that are prepared to put that equity in upfront. And then number three, the management capacity, because if you don't manage the project correctly, then it loses value and for everybody. So maintaining that value is super important in the physical plan as well as the residents, managing the residents' occupancy levels.
I think the perspective I'd like to just add to this is that all big portfolios start with an entrepreneur. Divercity started with Rian and Gustav. The AFCO now, SA corporate portfolio, started with the Plitt brothers, et cetera, et cetera, et cetera. Certainly our experience is that entrepreneurs, because we're not a housing finance company, we're an SME financing company with a housing outcome, start with a building or two and build, and then consolidate and consolidate over time. So it is important that there's a number of entrepreneurs working together to allow this development to take place and the consolidation to take place. As I say, Divercity started many, many years ago. In fact, even before that, with somebody called Brian Miller. And so you build up a portfolio and you develop the property management capacity as you go along. So I would just add that from a capital markets investment point of view, I think credit enhancement's not as important as the underlying fundamentals. And we've got a growing list of investors in our securitizations that are taking positions. And the ones that are on the side often ask very strange questions, like they're worried about land invasions. They're worried about building hijackings. They're worried about evictions to the extent that there's a reputational damage. And in our experience, we've never had a land invasion. We've had a few building hijackings in the 1,500 odd buildings we funded, maybe 3 or 4. I don't know what that percent is, but it's quite small. And they've always been remedied. And we've never not been able to perfect our security as an investor, as a lender. So it is important that, this distinction between perceived risks and actual risks. There are real risks that can be managed, but land invasions, hijackings aren't one of them, certainly in TUHF's experience. And that's a countrywide perspective. So here we are, and we are looking to the future. What is the future of this asset class? Zanele, you asked the question in our little chat group, so I'm going to open with you. What's the prognosis? How are we looking in respect of demand for rental escalations, those underlying commercial fundamentals? And if any of you guys have a perspective on student housing, I've got one, but if you guys have, please start bringing that in, because it is kind of flavor of the month in South Africa and in South Africa cities. Zanele, seeing as you started this topic, can we start with you? Go for it.
I think for student housing, I must say it's been phenomenal, the support of NSFAS for this particular sector. South Africa doesn't actually, I would say, export students or import, let me just put it, people coming in, students coming in. We don't import a lot of students, so a lot of our tertiary student base is local, and it is households with very constrained income, very much reliant on the state. And what NSFAS has done, especially in COVID, is that for private investors in student accommodation, they kept paying. So they actually strengthened the investment case for student accommodation. And the ability to increase rentals going forward, whether it's in student accommodation or affordable housing, I think anything way above CPI would be very much unrealistic, because we are still faced with the economy that we are actually operating in. So we have to be quite realistic. But I think the great thing about this particular asset class is that solutions will be found, because you can't have a strategy towards education, healthcare, and you miss out the housing part. It doesn't make sense. So the three of them always go together, even in terms of food security. So it's not an asset class that you can easily ignore. So the commercial case and the investment case will always be there, as long as we keep finding solutions as to how do we make this asset class liquid, and when, for instance, in my perspective, a pension fund would actually be able to invest. But in terms of rentals going forward, I don't foresee rental reversions, but I do foresee that CPI, CPI in South Africa has been quite high, and I think globally as well. I think anything that's CPI related would be acceptable for the short to medium term.
Thanks, Zanele. Carel, what about you? What are your prognosis? And the state of the underlying commercials, cost growth, rental growth, those kind of things, the construction costs. Where are you guys at Divercity? Well, you're building a 1.5 billion rand development up the road, but where are you on this?
I think in the short to medium term, it's undeniable that there's significant inflationary pressure within the economy, and we're seeing that in construction costs. We've just priced the bill with Barlow. Fortunately, we've come in within the tolerances that we'd allowed for, but it was, quite a concern there for a moment, because, we import a lot of construction materials still in South Africa, and I know that's, particularly the case in many of the countries in the rest of the continent. So construction cost inflation is a major, let's say, dampener in terms of the viability of any kind of property sector at this stage. Having said that, that inflation washes through into wage growth eventually, and that in turn, impacts households' ability to pay rent, and that, props us up again in the medium term. So, we are very confident in the fundamentals of the asset class medium term. There's undoubtedly a bit of global kind of pressure at the moment that we just need to make our way through. But again, I think once you've got a kind of a well-managed yielding portfolio, then provided you've got good relationships with your financiers, you should be able to kind of get through that just okay. I just want to briefly come back to the question on kind of looking towards the future and pick up the point on property management. I think property management in this space is absolutely essential for a portfolio to succeed. I think more so than in the case of, for example, commercial property, office buildings, retail, and the like. See, we're getting the 10-minute sign. I'm just acknowledging that. But it's also not an insurmountable challenge. And I think tomorrow there's the PropTech Forum, and I think it's worth noting that technology is also assisting greatly in making the management of large rental portfolios easier, every year as time goes by. So if you've got the right team and the right people that are entrepreneurially minded and willing to, work extremely hard at property management, then it's definitely doable. And I think, to your point, Paul, I just want to reiterate that this isn't something that can't be solved. We just need the right guys to kind of start cracking at it, amassing units, and use common sense and start, using the tools that are out there in the form of technology and the like to manage their portfolios. And then the last bit I think that I would like to see in the future going forward is we need to start educating our industry collectively, and in particular asset managers at large institutional investors around the fundamentals of the asset class. I don't hold it against any asset manager in, for example, the South African pension landscape that doesn't have a nuanced understanding of the asset class, because it's been trivially small up until now. So why would they know anything about it? But it's our collective kind of task, and conversations like this I think start that quite effectively, to start saying, having a discussion around what does this asset class look like, what are the things that you need to look out for it to be successful over a long investment period, and then I believe we can grow quite well from there.
Yeah, I think that's a good way to conclude. I would just add on students, TUHF has a fairly large student portfolio, is that the property management and student is much more like the hospitality industry rather than the residential real estate industry. And you've really got to understand that to be successful in students. It is significantly different. We've learned the hard way with our clients that you've got to get that part right. And then the cash flows are often not as predictable, not because of NSFAS, but because the universities are constantly changing. They pay, but it depends on the university. I think that's probably a good place to stop our discussion and ask the audience whether there's a question or two that you'd like to pose to any one of the panelists. Because we've been getting the 10-minute, it's now about 8-minute call. So any questions from the audience? We got one over there, please, just on the...
Thank you. Sfiso Ngoma here from the PIC. I just wanted to find out about the Joburg inner city in particular. Where is it going? What will drive future demand in the node? Yeah, because it's quite topical and of interest at the moment. Thanks.
Amelia, will you start, and then Carel, perhaps?
Yeah, sorry, so I couldn't entirely hear. I guess it was just the positioning of where we see the Joburg inner city at the moment. So, as I mentioned earlier, the Joburg inner city is just so well placed to deliver what we need from a housing perspective, that it's absolutely important that all players get involved there to make sure that we use it to its absolute capacity. Obviously, you've got bits of the Joburg city that work, that don't work. I mean, touching on student housing, we were walking through, the streets of Bromfontein a couple of weeks ago, and it was actually amazing to see how clean the streets were, how good the whole area was looking. So it's going to come down to us taking a clear decision to support the Joburg inner city, and then partnering up and having collaborations with the city, with any other participants who have an interest in the Joburg inner city, to work together to make sure that it's a success. Not sure if somebody else wants to add.
Carel, go for it.
I'll be very brief. I think the Joburg inner city has a lot going for it. It's still the largest employment center in Gauteng, and for that reason in Southern Africa. It's very centrally located, kind of by virtue of how the city grew, and it remains a place where a lot of people go every day. So there's a lot going for it. However, it is I'd be remiss not to acknowledge that it is facing substantial infrastructure decay at the moment, and there is a challenge around reinvestment into infrastructure in the Joburg CBD, both in terms of hard infrastructure but also service delivery. And as dense urban environments go, they kind of take a lot of strain in the day-to-day of that place, and it requires upkeep. And unfortunately, we are seeing, I believe, underinvestment from local government into the services and infrastructure of the inner city, and that would need to change, I think, in the medium term for it to remain kind of the economic hub that it is today.
So I would add to that, the Braamfontein's clearly benefiting from the Wits Reimagine program. It's become a student town. You've obviously got Liberty and a few others still there, but the idea is it's a well-run node. If you go directly to the other side, the sort of Jeppe's Town, Malvern, Denver, it's an absolute mess. And coming from the first round of xenophobic violence that we had in South Africa. And it really boils down to urban management. The World Bank used to have and I believe we'll start having again a meeting of the big metros. And I used to be invited to it, and I made the following observation about the inner city of Joburg. Johannesburg is a city with world-class urban development plans, but is probably the worst-run city in the country. Whereas eThekwini or Durban is a very well-run city, but it's got no plan at all. And it's quite hard to put that. And so your investment case needs to understand that cities are made up of component parts, they're made up of interest groups, and the role of local government really does need to improve in South Africa, and particularly in terms of the basics of urban management. Any other questions? We've got time for one more. There's a question in the middle. Or maybe two more, Madam NC. Just one. Okay. This is our last question. Thank you.
Thank you. I'm Shamin Sukia from Mauritius, Belgium capital. Just a recollection of facts. I just recollect from, I won't say old days, but about a decade ago, about impact investments, where in Mauritius we wanted to create a platform to attract capital. And we had some very good connections in Africa, through South Africa, and even on the Far East, so Singapore, Malaysia, Indonesia, etc. So the problem was that at that point in time, the critical mass was a real challenge in uniting all those funds and then directing. But it's just an appreciation on my part, because I've seen all those developments, and I've heard, in the morning, there was from Lango, somebody was on the panel, Thomas Riley, speaking about, Lango investments, seeking funds, from Asian impact funds, investors. So maybe from the audience, I would like very briefly maybe just a sort of appreciation of the fact that we've seen so much that have been done, ramping up the ladder in terms of sensitization in respect of impact investments across the impact investor community. Thank you.
I'm not sure I understood the question. Can you repeat the question?
Well, I think the question really revolves around this increasing attention to and build-up of impact investments, and particularly Mauritius as a capital base, but looking at this increasingly interest in impact investment assets. In other words, hard commercial returns and leaving a legacy, or making a change, or doing something good together. Debbie, would you like to?
From our DFC's perspective, the commercial aspects and the credit aspects of a deal have equal weight with the development impact. And that's one of the reasons why I really, really like this asset class, because it has the best potential for delivering on that development impact at a significant scale. What I want to say, though, is with respect to the commercial aspect, because everybody here who's developing these types of assets has to basically build an understanding of what all that is. You know, IFC's performance standards, there's 5 of them, and you practically have to go to college to understand how to implement the performance standards, measure impact. No developer I know has a devoted team for measuring impact, going around and surveying occupants, except Divercity. But, you know, it costs money, right? It costs money to have people who do that and report. It's extremely valuable. Everybody wants it right now. But I think on the ground, it's very difficult for developers to build that capacity. I think this whole area is ripe for disruption with technology. With property technology, I think there is a lot that can be done differently, that we can think about more creatively, that would help us manage that, achieve the objectives, the impact objectives, but do it at a cost that's manageable for everybody.
Thank you, Debbie. I would agree. There is increasingly interest in impact investments broadly as an asset class, and this asset class as a result. But measurement is very, very important, and how you measure and what you measure. It's got to go beyond a green effect and job creation. It's about stimulating local economies, creating urban densification, and a range of others that we'll pick up at another time. Madam NC, panel, thank you very much, and to the audience for joining us and staying just before lunch. I hope you enjoyed it.